I was like, we're probably gonna close right around Vega neutral, and that's what we did. We closed right around Vega neutral. Staying kind of pinned to that, it's a bit awkward. The fact that we're below it, and I believe just above the monthly VN probably means we'll struggle a little bit tomorrow if we don't sell off with the PPI print. Then tomorrow's price action could be just really similar to what we had today. For ES, we've had one, two, three, four tests of the 6,000 support. I will say that the bounce today off of the last test of the 6,000 support was a little bit weaker than the prior bounce, and we're probably going to test 6,000 again. How this hasn't failed yet is beyond me, but it's definitely not getting stronger on multiple repeated tests of that level, and it does appear that we have pretty solid resistance to the upside at 60.34. This is a failure of the trend on the 1 hour. Well, at least a rejection. I would say that a failure of 59.67 would confirm that and open a test of the lower trend again. If we were to break out of this, which we have not for, well, since August. But if we were to break out of this, we could fail to the long-term lower trend, which would be interesting. As price action in this trend is in fact consolidating, it is not getting lower lows, at least not for the last 3 months. Commodities up a little bit in the back half of today, but down overall. Gold, silver, copper, all down. We're continuing to see Chinese markets sell off. Obviously, the continued strength in dollar is very bad for them. Oil still not really regaining 68 a barrel yet. And we haven't had any flare up in, geopolitical discourse. So, really nothing going on with oil right now. Kind of boring. S&P up 5% today, but NASDAQ, Russell down, Dow up. So a little bit of breadth still supporting us here, but that seems to be waning, and tech does seem to be getting weaker as the dollar is starting to hit levels where it's going to impact credit and margins. The 10, 20, and 30 year all also up today, rising with a slightly warmer CPI print. Correlation actually starting to turn around a little. Looks like we bottomed out earlier today and got a tiny bit of reversal. Far from confirming anything here, but we might be getting fairly close to maximum of the available leverage here. And if we do, correlation could break down very rapidly. Carry trade now at 8.5x. 8.54x on the long end, 7.27, 7.17 on the 6 and the 3 month respectively. Forward yield on vol hitting a new lower level today after a week of trading at around -3%. We're down to about -9. So they're really just shorting the fuck out of volatility. And in order to keep getting the premium they need to do that, they're going to have to keep shorting vol closer and closer to spot. And that's why we're not seeing Vega neutral really lift off of where spot is. And even yesterday we saw it come down. Despite us holding these prices, VN came down, and until some of those short vol positions capitulate, Vega neutral is not going to move away from spot. It's going to remain fairly hard resistance to the upside. Move did go back over 100 with yesterday's price action. Probably a little flatter today with the front end of the curve kind of falling, but we are getting a little bit of bond volatility back. Skew, tiny bounce back, but nothing significant. 63.02% of the S&P over its 20-day moving average. And I think we're probably just going to see continued breakdown in correlation here. Yeah, on the VIX, getting pretty close to the levels we were at, around July when they shorted vol really hard before the currency spreads kind of collapsed a little. Fed fund futures after today's print, pricing up potential rate cuts to 0.47. That could turn back around with PPI tomorrow, but adding about zero point 0.1 more cuts by June of next year. And then the spread between the 10 and 2-year widening even further today. I think yesterday we were around 0.883%. Today it's 17.4 positive. So the bear steepener just kind of continuing on as the front end starts to pare back and the long end continues to rise higher. And this is the action that I was looking for those short paper positions to be at risk, very specifically, because what they're doing is they're shorting the short-term debt instruments to provide credit to carry the long-term debt instruments. And as long as short paper is improving in price, which it's not today, right? So as long as yields at the short end are rising, then yields at the long end can also rise without too much damage to overall credit conditions. But today, specifically, we have, yields on the short end falling, short term down, long term up, right? And what this does is it pulls the leverage the other way. And, the short position is now underperforming and the cost to carry is rising. And this kind of price action exacerbates risk far, far faster, right? Because you have both instruments moving away from where they need to hold them in order to control that risk. Is this like where Spider-Man is trying to hold the train and then the end doesn't? I think it's like in, what was it? Was it like Game of Thrones? What was the TV show? Oh no, like in The Boys when Homelander just like rips that guy in half. It's like that. Juicy. Yeah, exactly. All right. Anyway, that's what I got. Thanks, guys. I'll see you bright and early tomorrow. Maybe. Have a good night, everyone. Later.